Okay, I think we are going to go ahead and get started. I'm Heather Renfro. I'm the Vice President of Prevail Strategies. I'm so excited to be here today. I just, I'm in a group of a whole bunch of people. It's so nice to see so many smiling, friendly faces. Just real quick, everybody will be muted so we can eliminate all of the background noise. If you have a question or if you want to ask, down here along the bottom of your screen, there should be a place that says chat. And we have a moderator with us today, and that moderator will be monitoring the chat room with us the entire time. So if you have a question, just put it in the chat box and Garrett will address the question at the end. So how many of you, and I see several faces here, how many of you by show of hands have been on some painfully boring webinars over the last? Yeah, in my opinion, do they seem to get longer or is it just me? I can tell you that the webinars are definitely a new norm, right? But I'd like to let you into my personal life a little bit and I'd like to show you my new norm. I run a pretty tight ship. I am the mom of a 17-year-old teenage boy, and here's my new norm. There's a driver. Right here, we have a fishing pole and a tackle backpack. And my favorite, which I still am so glad this is here today, because I think it's just me, but is it odd that there would be a bow and arrow right here on my staircase? Oh, you never know when you're going to need your bow. What I think is interesting is this has become our new norm. Notice that you don't see a school bag. Notice that you don't see a notebook or a laptop. But today I'm not even here to talk about the norm. As a matter of fact, Prevail Strategies kind of shies away from the norm, and we like to introduce you to new outside the box concepts. We are so excited to have Garrett Griffin with us today. Admittedly, I've known Garrett for about 15 years. He has a law degree with a master's in taxation, so he's a pretty smart guy, but a pretty average golfer. He's a good putter though, so he fools you in the beginning and he looks like he's going to go over par and then he makes a miraculous putt, saves the day always. But Garrett has such an interesting way of taking really complicated outside the box topics like deferred sales trusts and breaking them down into simple, understandable segments. So I hope today that you are able to take a little bit away from what Garrett has to say. Again, it's a little outside the box, may not apply to you, or maybe it does. But if you have questions, please direct those in the chat box below, right down here on your screen. Or if you'd like to get a hold of us, of course, you can contact us through the website. So if you have any questions, please let us know. If not, thank you so much for coming today. So it's a little hard to be inside with all of our cabin fever, but we're really glad that you decided to join us today. Thanks. Garrett?
All right. Well, yes, she is right. My golf game is pretty average, and so we won't spend a lot of time on that today. So thanks, Heather, for the introduction. She's right. The weather outside is beautiful. So, you know, first off, greetings to everybody. I hope you're having a great day. I want to thank you all for attending. I know that your time is valuable, so I want to make sure that you get some great information today. The concept that we're going to discuss today is a unique approach to deferring or even eliminating taxes from the sale of highly appreciated assets. And so we've titled this webinar, A Way Out, Reducing Your Tax Burden on Highly Appreciated Assets. So I was introduced to the Deferred Sales Trust in 2017 and really have been exploring its uses since then. And it really does apply to multiple classes of assets. And so if you think about this question, you know, are you unwilling to sell highly appreciated property because of capital gains taxes? You know, is there that fear and you're kind of, you know, you have that paralysis that, you know, I really don't know if I want to sell because that impact is going to be significant. Do I just continue to get, you know, if there's income producing property, do I just continue to take that income rather than, sell the property and incur that capital gains tax liability? And the deferred sales trust certainly can be the answer. It has the ability to defer those capital gains sales on almost any type of highly appreciated asset. And we'll talk about the various multiple classes of assets. So did you know that primary residences, businesses, and investment real estate make up about 50% of the U.S.'s wealth? And as we know, owners of businesses, real estate, and other highly appreciated assets are often reluctant to sell due to significant capital gains tax liability that can result. Again, the deferred sales trust is a way to defer the capital gains tax on almost any type of asset. So we're talking about high-end primary residences. So if you've got a high-end primary residence where you do have some capital gains exclusion between a single person and husband and wife, but if you have a highly appreciated piece of property where your exclusion is not enough, this potentially could work. Commercial real estate, various investment properties. So I deal with a lot of farm and land clients. Those appreciated farm grounds will work. Major private stock positions, businesses and other professional practices, and even valuable artwork and collectibles, including cars. So antique cars would certainly fit potentially into this. So the deferred sales trust is really a specialized type of installment sale under the Internal Revenue Code Section 453. And so that's really kind of the area that we're dealing with. So that's been around for a long time. We're dealing with some pretty well-recognized law. And the Deferred Sales Trust was created by a tax attorney. His name's Todd Campbell. Todd has both a CPA firm and has a law firm. And so Todd had the fortunate ideas of having this Deferred Sales Trust. He was working with a large tax firm, came up with this structure, and has been using it for some period of time now. The Deferred Sales Trust, then, Todd partnered with the estate planning team to offer this and exclusively to their members. And so the estate planning team, it really is a membership-based organization. And the Deferred Sales Trust really has become successful because of the team approach. That membership certainly has the necessary expertise. It is a pretty wide network, but there is some exclusivity to it. And so the Deferred Sales Trust is only offered through the estate planning team members. The estate planning team, along with that network, they've really created the infrastructure that's necessary to support the Deferred Sales Trust in the initial implementation as well as the ongoing maintenance. And so as we look at and we start getting into, well, what is the Deferred Sales Trust, one of the big things that always comes up was, how do we know that it's legal? So as I mentioned, we're basing this upon Internal Revenue Code Section 453 that deals with installment sales. That's been around for a really long time. The Deferred Sales Trust, though, in and of itself, it's been used for the last 24 years. And with several reviews by the IRS, it's been reviewed by some national law firms for particular client situations. But the IRS has looked at this, and there have been no changes on any of the audits that they've happened to do. There have been some audits, but they've been no trigger audits, which basically means that the Deferred Sales Trust was not the reason that the audit was occurring. However, and we'll talk a little bit about this at the end when we talk about some of the fees that are associated with it, but if you're engaged in the Deferred Sales Trust, the Campbell Law Firm also provides some audit defense. So if the transaction is being audited, we have a way to pay for that audit protection. And I mentioned that the estate planning team has the infrastructure to support this Deferred Sales Trust. And as we'll kind of talk a little bit in how this works, the Deferred Sales Trust needs an approved third-party trustee to implement this strategy. Currently, there are 14 approved trustees across the U.S., and I happen to be one of those 14. And so, like I said, I've been working with the estate planning team since 2017. and trying to explore the uses of this. And so I've recently become one of those 14 approved trustees. And in terms of some background, we're looking at the perfect storm with regards to why this Deferred Sales Trust really has some power and really works well. Right now, every day, about 10,000 baby boomers every day turn 65. And the amount of wealth that they have accumulated is really staggering. You hear those stories about the wealth transfer that's coming in the next 20 years. The number, it's ranged all over the place. The highest I've heard is about $45 trillion worth of assets that will transition from one generation to the next. I had just mentioned that primary residences, investment real estate, and businesses make up 50% or more of that wealth. And so we know that we have kind of this boiling storm here. From a taxation standpoint, the net investment income taxes have been created here recently. We all know that. It's somewhat of the Obamacare tax. It's kind of an additional tax that you may have to pay based upon where income is. Also, many states have increased their state income taxes. So we have this taxation standpoint, even though we're in relatively low tax environment, we still have this increase. We still have this kind of, again, you have that paralysis of, I don't want to sell these particular assets because I don't want to get hit with that tax burden. You've accumulated the asset has appreciated in value, and you just have that reluctance to sell that asset. We also have some unique influences. Interest rates are at 40-year lows and are probably going to be held there for the foreseeable future based upon everything that's going on. Real estate has appreciated quite a bit over the most recent years. Now we'll kind of see how that plays out with the current virus situation. But certainly those two aspects have made it really unique opportunities for buyers as well as sellers. I just recently read an article from Biz Buy Sell, which is it's really a warehouse, an online warehouse of businesses that are for sale. And they published an article last week, and it talked about the coronavirus, the impact, and what it was going to do to potential business sales. And so if you think about it, obviously there's going to be an impact to several bottom lines, across the board, multiple industries. And so you're going to see potentially the value of these businesses go down a slight bit. And they're going to go down again because based upon, maybe their gross income or their net income or their EBITDA, whatever the case might be, when you're looking at a valuation, that valuation is going to be impacted, and that's going to impact their ability to generate a higher sales price. So all those things kind of working together have created this perfect storm and really created this opportunity for the Deferred Sales Trust. Because when you look at it, a seller, they don't have that many options. Like I said, you could be in the position where you say, you know what, I feel like I'm stuck. I have this trapped wealth. I don't know what to do. And so, my option one is, well, I just don't sell. Option two, and this is just specific to real estate, you can say, well, you know what, maybe I want to do a 1031 exchange. But again, that does not apply to that host of assets that we originally looked at. So your businesses, your art, those type of things, only the 1031 is going to apply to real estate sales. So you could do a 1031 exchange. The problem with the 1031 exchange is you're still in the game. And so if you're truly looking to exit, you're truly looking to maybe extract yourself from that trapped wealth, then the 1031 exchange may not advance you in that position because you're still going to have that replacement property. You're still kind of in the game is kind of what I like to say. You could consider the Deferred Sales Trust. We'll talk about what that looks like, how it works, and what the benefits are. Or you could simply sell the property and pay the tax and use the net after-tax proceeds to invest. And so I want to look at a hypothetical scenario. So John Smith just sold his manufacturing business in KCMO for $7 million. So what does that look like? And I've simplified the math just a little bit, but if we talk about a $7 million transaction, and let's say John had $250,000 of basis. His taxable gain is $6,750,000. So if you consider federal capital gains taxes, potentially some recapture if he's taken any depreciation, state level income tax, as well as Medicare taxes, his taxes due could be as high as $2,011,500. So he's got a $2 million tax bill that he's going to have to pay on his $7 million that he's received. So pretty significant hit. So let's look at then, well, how does the deferred sales trust work? Well, in this case, we've got the client. So let's say that's John. And he's got an asset. And so I've shown the building, I've shown the assets that he's got, and he wants to sell his business. So what's going to happen? So John's going to sell his asset to the Deferred Sales Trust. And again, that's to the third-party trustee that has created this Deferred Sales Trust. In exchange, and this is where Section 453 comes in, John's going to take back a promissory note. And we'll talk about some of the elements of the promissory note in a minute, but essentially John is going to help dictate what that promissory note looks like. So it's different than traditional financing, where you may have a seller finance transaction where he's selling to the third party directly. In this case, he's going to be able to essentially negotiate with the trustee on much, much more favorable terms, really being able to design that promissory note to what he wants it to look like, the return he wants based upon the terms that he wants. So a lot of flexibility there with regards to how potentially, if and when he wants to recognize the capital gains. So the Deferred Sales Trust then, almost simultaneously, is going to sell that asset to the third-party buyer. The third-party buyer's likely already been identified. The purchase documents have already been executed. And so the purchase documents just have a provision that allows the seller to enter into a Deferred Sales Trust at no cost to the third-party buyer. And so, again, really just right at closing, prior to escrow closing, we're going to have the Deferred Sales Trust essentially selling to that third-party buyer. The third-party buyer then is going to pay cash to the Deferred Sales Trust. So the Deferred Sales Trust is getting the gross sales proceeds in this situation. So think about this. So again, let's use John's example. The Deferred Sales Trust bought the asset for $7 million, turned around and sold to the third party for the same $7 million. So $7 million of cash comes into the Deferred Sales Trust. Well, if we think again about sales price and basis, sales price was $7 million. So the Deferred Sales Trust, that is its basis. So it has a $7 million purchase price and a $7 million basis. So when it sells to the buyer, there's zero capital gains tax recognized at that point in time. So again, that Deferred Sales Trust has the gross sales proceeds. So then the Deferred Sales Trust has the ability to invest those gross sales proceeds. But the client who has sold the assets holding the promissory note, now they're acting like the lender. And as the lender on a non-recourse note, they're going to have the ability to approve what the suitability is for those Deferred Sales Trust investments. So they're going to work with their advisor in allocating what that portfolio looks like. That portfolio is partially going to be driven based upon the terms of the promissory note. What type of interest rate is the client going to receive on the promissory note? We need to make sure that the investments are allocated such that it can produce that type of return. So what happens is the investments produce the income and turn around and provide that income in the form of the promissory note payments to the client. So again, the cash that is being produced inside of the investment, that income at the Deferred Sales Trust level, because the Deferred Sales Trust owes that money back to the client via the promissory note, those payments then are made over time to the client. Again, the client is really in control here because they're setting out the initial terms of the promissory note, what do they want that to look like. They're also then going to approve the suitability with their investment advisor as to the investments. So the client, their advisor, as well as the trustee work in conjunction with one another to allocate those funds appropriately so that they're going to produce the return to be able to pay on that promissory note. So the trust then creates that cash flow. So what does that do in John's case? So if we look at our scenario with John, again, without using the deferred sales trust, he owed tax of $2 million. And so he had net proceeds to invest of 4.9. But if John moves through with the deferred sales trust, he gets that same $700,000. He does have some basis, $250,000. So his taxable gain is still $6.75 million. But because we've deferred all of the capital gains tax, he owes zero taxes at that time. So taxes due is zero. So thus his net proceeds is almost his full closing costs. Now there are going to be some fees generated with regards to entering into the deferred sales trust. So it's not the full $7 million. We're showing that net of that. But essentially it's net of all of the tax. So we've not paid any capital gains tax. So the net proceeds, $6.9 million. So he's got almost that full $2 million in addition, as opposed to not using the deferred sales trust and owing that $2 million to the government. So he's got that extra $2 million to invest over time. So the deferred sales trust really has the ability to generate more wealth in the long run. So let's assume John runs this note out for a couple of periods, and let's say he does 2 10-year notes. And at the end of that 20 years, because he's had that extra $2 million to invest, he's been able to generate an additional. So it's not just an interest amount. This is an additional interest of $1 million. By saving the $2 million initially, that invested over time is going to produce him an additional $1 million. And still, at the end of that 20-year period, he's going to have some flexibility with what he wants to do with the note. He could renew the note for another 10-year period. And if he does, he still has that excess $2 million to continue to invest. So pretty significant ability to generate additional wealth over that period of time by using the deferred sales trust. So let's look at a little bit different scenario. So he was selling a business. Now we've got a client who's going to sell some investment real estate. They've got a piece of property that they're going to sell for $12 million. They've got basis of $750,000. So in each of these cases, whether we don't use the deferred sales trust, whether we do use the deferred sales trust, we've got taxable gain of $11.25 million. Not using the deferred sales trust, we've got $3.3 in tax that we're going to owe. That's going to leave the seller with net proceeds of about $8.6 million. Again, if we're able to use the deferred sales trust and defer that capital gains tax on the sale, we're not paying anything at that closing. And so now our net proceeds are $11.85 million. So we've got that excess of $3 million now that we're able to use. The client is going to be able to invest that really, again, based upon the allocation that they see fit that is going to be suitable for the terms of the promissory note. So we've got a lot of flexibility and control there. Again, the ability to substantially generate more wealth over the long run. In this particular case, then, we're able to produce an additional interest of $1.7 million over that 20-year period. Again, same type of situation. We have the ability to continue to roll that note over for consecutive 10-year periods. Obviously, the longer we let that roll, the more impact on the positive side that we're going to have. We're going to be able to continually generate substantially more wealth over time by not paying that capital gains tax at the sale. So a lot of times, several different questions come up with regards to, well, you know, is the deferred sales trust going to be is it going to work for me? Is it really applicable to my situation? So we've got a couple of frequently asked questions that I like to address. And the first is, well, what's the minimum transaction size where this truly makes sense? Well, most of the cases tend to average between $3 and $5 million in the transaction size. Economically speaking, though, when you have about $500,000 worth of capital gains tax liability, being able to push that into the future and use that additional $500,000, that's enough economically to make sense of the transaction and potentially then the fees that we'll talk about later. So obviously, the higher the capital gains tax liability that we're deferring, the more benefit that we're going to have. As you look at then the transaction, you say, well, what is the term then going to be on this note? Most of the notes where you really have the power is if you're going to defer that for a 10-year period. So there is a maximum term of 10 years. There is no minimum term. So you could have a shorter term note. The issue, though, is if you have a shorter term note, when you start getting that principal payment back, you're going to then be paying the capital gains tax. So the longer that you leave the note in place, and this is where you see you do a 10-year note, you renew at the end of 10 years. And now that the Deferred Sales Trust has been in existence for more than 24 years now, we're starting to see the third iteration. So we're seeing the third, basically the second renewal, but basically the third 10-year term. So again, the longer that you leave the principal in the Deferred Sales Trust and not taking that off the table and getting hit with the tax, the longer that we can continue to defer that, the more income that we can generate based upon that tax liability that we've not paid. So again, the maximum term is 10 years, but there really is no minimum. So a lot of times we get the question, well, can I keep some of the cash when we do the initial sale? And absolutely you can do that. Obviously, to the extent that you have some basis, you potentially could take that basis off the table. You wouldn't owe any capital gains tax on the basis that you've been returned, but anything then in excess, so any part of the capital gains tax liability, you would, if you take that portion off the table and you take that in cash at closing, you're going to be liable for the capital gains tax in that particular situation. So, but there is that flexibility, because you may say, well, I want to do some different things. I want to take some of that off the table. Maybe I want to take half the transaction off the table. I pay my tax. The other piece, I want to roll into the Deferred Sales Trust. So very flexible from that standpoint with regards to what you want to do at the closing of the transaction with regard to the purchase price, as well as that promissory note term. The other question we get is, well, what happens if I pass away? Well, the first thing to mention is that, unlike some assets where you have a low basis and a high fair market value, promissory note that you hold does not get stepped up basis. So, if I own a piece of real estate and I've depreciated my basis, and then I turn around and I pass away and my child inherits that piece of real estate, their basis now becomes whatever the fair market value was at date of death. That's not the case with this promissory note. So there is no step up in basis on the promissory note. But a lot of times you still have the desire for clients to enter into the transaction because they want to cash out prior to death. They're not quite as concerned about what I'll call the wealth transfer piece of the asset. They're ready to cash out now. So the promissory note is just like any other part of your estate. It's just like any other asset. You have to deal with that as an asset in terms of, well, what do I want to have happen with this in the event of my passing? So assuming for the moment that you've created a living trust, which would be my recommendation, you want to make sure that the note is somehow tied to the trust. We call that funding the trust. So you want the note somehow paid to the trust. That can be as simple as an assignment of the promissory note upon death to your living trust. At that point, then, the asset, the promissory note, becomes a part of your trust. So depending upon the terms of the trust and who your beneficiaries are, whether it's a surviving spouse, whether it's children, whether it's grandchildren, the terms of the note continue. Those beneficiaries then have the ability to continue to receive that income stream payment based upon the terms of the note, and then ultimately have the option to continue to renew the note for the 10-year period. So they essentially step into the original seller's shoes, having the ability then to continue to somewhat kick the can down the road, so to speak. So they can continue to defer that capital gains tax, continue to use the difference, that capital gains that would have been paid, to continue to invest to produce income that pays back to them through the promissory note into the trust. The trust then, as a beneficiary, they're able to take distributions of the installment note payment. So it becomes an estate planning tool, and again, really has some leverage with respect to how that can transfer in terms of the wealth transfer side of it. So one of the other questions or comments or misconceptions that we get is, well, won't I lose control? You know, if the deferred sales trust has the assets, don't I lose control? Well, first remember that as the client is the lender, they are directing the suitability with regards to their investment advisor and the deferred sales trust trustee. So as the lender, because you've got these three parties that are involved, all three parties are agreeing with regards to how the assets are going to be invested, with the client, who is the seller, really dictating what does that allocation look like, because the allocation has to match and produce what we want on the back end with regards to the promissory note. So there's that initial flexibility. What I think one of the most unique pieces to this concept is what you're seeing here with this little schematic. And that is that with the deferred sales trust, you can get back into a new deal. And so if we're going to say the new deal is the LLC, and that may be a new real estate investment. That may be a new business. So it doesn't matter what you sell, whether that be a business or real estate, you can get back into a new deal that is different from what you just exited. So when we think about, certainly for the real estate investors who may be on the call today, this is a great alternative to a 1031 exchange. So when we're talking about a 1031 exchange, there are all types of restrictions and parameters in which you have to operate with regards to identifying property, closing on the new property, holding periods. You have a carryover basis. So the basis that you've depreciated down, that follows you into your new deal if you do a 1031 exchange. The great thing about this is not only an alternative to a 1031 exchange, but it also can be a 1031 rescue. So if you are coming up against your time limitations in a 1031 exchange, there is a way to move that money out of the qualified intermediary and into the deferred sales trust. They do it through a defeasance agreement, but basically you can move that over to the deferred sales trust. The deferred sales trust then does not have those timing issues with regards to going back into a new deal. So you can sit on the sidelines, wait for the right property, as opposed to being forced into something that you don't want. The other thing that is great about this and is that with regards to real estate investors, when you buy back into that new deal at the LLC level, you are able to reset the depreciation schedule and thereby shelter the income. So I want to say that again. Normally when you do a 1031 exchange, your depreciated basis carries over into your new deal. But when you do this through a deferred sales trust, and the deferred sales trust is going to basically buy in at new fair market value, you get to reset the depreciation schedule, and that new depreciation schedule is going to help shelter that income. So very powerful there. So let's look at then how do you get back into a new deal, and what are the restrictions and potential limitations of the deferred sales trust. So in this particular case, the deferred sales trust had $5 million in it. And so there is a limitation that the portfolio can only allocate up to 80% of the deferred sales trust funds into a new deal. So you do have to keep some efficacy. You do have to keep some sort of liquidity so that $2 million can be managed money, but you do need to keep that in terms of kind of a portfolio. So we have the $2 million. The $3 million then that it has left is treated as a capital contribution into the new deal. And again, that LLC, it could be buying a business. It could be buying real estate. So very flexible from that standpoint. It could buy a partnership interest. So very flexible. That $3 million capital contribution from the trust makes the trust then a 20% preferred member. So this is kind of how the LLC is structured. So that trust then has a preferred interest in the income that comes back out, 20% preferred. The client, who was the original seller, holds the promissory note, now becomes the 80% managing member of the LLC. So it's going to make decisions with respect to the new deal that's being purchased. So that gives that client the ability to control the new deal as the managing member. Then, again, even though the trust has the priority, the preferred interest, that's money that's coming back to the seller. So the money, the income that's being generated in the new deal is flowing back through to the deferred sales trust, becomes part of the funds then that are able to be paid back to the client on the promissory note. And then the client is also still then the 80% managing member. So the ability to lose control here is really, really minimized. That there's a lot of flexibility. There's a lot of really unique things that can be done with regards to either purchasing back into a new business or other real estate. So really some significant power there. Very, very flexible and gives the seller a lot of opportunities. Again, especially if you've got a real estate investor who's looking at this saying, okay, I'm going to carry over this basis. I'm going to be forced into finding and identifying and closing on a property maybe faster than I want. So I don't get the ideal property. This allows you to hold the funds at the deferred sales trust level, make the investment when it makes sense to you. Again, the only limitation is that 80% of the trust value can be deposited or used as a capital contribution to the new deal. Still have to retain a 20% interest kind of in what I'll call the kind of that portfolio of funds there. So again, not losing control, really having the ability to have a flexibility to invest back into additional assets. So a really unique feature in this situation. Obviously, in all of this, we're really talking about taking the tax that was deferred, moving that into a vehicle that the client really is still able to invest and earn money off of. And so the structure itself, while yes, seems fairly straightforward, there is a lot of complexity to it. Obviously, with the complexity comes the various fees that are part of getting the infrastructure in place, part of doing the deal. There's a one-time fee to the tax attorney, so that's to the Campbell Law Firm, for essentially putting the deal together. So even if you have seller's counsel on the transactional side, Todd and his firm works with your counsel on making sure that the documents, the purchase documents are drafted in such a way that the seller is able to use the deferred sales trust, usually, again, at no cost to the buyer, and that all of that is worked into and part of the closing. So that is a one-time fee. It's usually somewhere between 1.25% and 1.5% of the trust value. And so again, that's a one-time fee, but that one-time fee then also, in addition to providing the legal and the tax structure, offers the audit defense. And so through Todd's firm, the Campbell Law Firm, they're going to be providing the audit defense with regards to if there happens to be an audit, Todd's firm steps in and defends that transaction. On an annual basis, then there is a trust management fee. And so it's a sliding scale based upon the asset value, and it's anywhere from 50 basis points to 85 basis points. In addition, a client that is going to be working with their investment advisor, there's going to be a wealth management fee typically that fee is going to range on an annual basis from 40 basis points to 65 basis points. And so if you think about the, kind of the fees in general, on average, that deferred sales trust is going to cost an extra somewhere between 30 and 50 basis points a year. And that's really kind of compared to, say, somebody that is paying a money manager and paying, an assets under management fee of somewhere in the 1% range on an annual basis. This is going to cost really about an extra 30 to 50 basis points. So that's really kind of the fee structure with regards to, obviously, there's a bit of a cost to get into the structure, but the ability to grow that deferred capital gains portion and be able to continue to invest that for a 10, 20, 30-year period can produce some significant wealth, not only for the seller, but obviously potentially then for, generations down the road as well. So with that structure put in place with regards to your own personal wealth transfer planning, it could be a pretty powerful tool. So what's next? So if you would like to book a discovery call with regards to the Deferred Sales Trust, I have included my link below. I'll let this slide stay up here for a little bit. That is my link to basically set a call, and it's usually a 30-minute call to talk through the Deferred Sales Trust. I have the ability to input, potential sales price of an asset. We look at the basis, we look at depreciation, come up with and calculate, okay, well, what are the tax savings and what is the potential for the impact over a 10 or 20-year period? What is that benefit to me? Does the benefit outweigh potentially the cost? Again, we said, it's usually a $500,000 capital gains tax liability that we're looking at deferring. And so when you look at that and you compare that to that time value of money over that period of time, does that make sense compared to the fees potentially that be charged? So we talked through that. Any other specific questions that you would have with regards to the particular transaction and how would it work in your situation? Here's my, here's the factors that go, are involved. And we look at that to see, are you a candidate? Does it make sense? So again, I invite you to schedule a call. Obviously, there's no commitment, no cost to you to have that discovery call, and would look forward to that. I'm going to leave that up for just a few more minutes before I move to my last slide, which is just my disclaimer. And I'm looking here. Beth, do we have any questions that I need to get to?
You are question-free, Garrett.
I'm question-free. Oh, everybody is being easy on me today. Well, I'm going to leave this slide up for just another minute or two, and we'll stay on just to see if any other questions pop up. Obviously, a lot of times the questions are specific to your individual situation, which is why we wanted to offer this discovery call. Again, I know the moving pieces can somewhat be overwhelming at times and complex, but if you think about it as really just a slight variation to traditional, seller finance, somebody who's selling their house and they're going to sell it to another buyer, and that buyer is going to pay them over time. And so it's an alternative, it's a derivative to that. I thought I maybe saw my screen flash here. Let's see. On chat. Let's see what this is. Okay, still looks like I am question-free. So I'm going to move into my last slide here. And again, just my disclaimer that I've showed. So I'll come back to this slide just to leave that on. If there are no further questions, again, I really appreciate the time today. Hopefully this unique concept was informational to you. I know, again, that it doesn't fit every situation, but we want you to know that we are, coming to you with alternative solutions where we know that clients they don't want to pay taxes, whether they think they're low or not. You know, we're in that camp where we're trying to do things for you. Look at these planning alternatives. Again, it all sits together too, which is what I really like about the Deferred Sales Trust, is that the way that the notes are structured, there's a lot of flexibility, and that flexibility can eventually benefit those future generations. Since no other further questions, again, appreciate the time today. Thank you for your attendance, and would look forward to you booking a call with me and talking through your particular situation. Everybody have a great day. Thanks so much. Bye-bye.